Good morning, everybody. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today, June 9th, 2025. If you are interested in commentary intra-week, that is between these weekly commentaries, you can find me on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation that I have prepared is designed to be used by you. Whether you are an individual investor or a financial advisor, it matters not. But you are all expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment or tax advice. No recommendations for the purchase or sale of any securities. The opinions expressed in the presentation are mine and mine alone. They may differ from the views of CFIA's parent, the affiliates, or other portfolio managers at the firm. Well, we've got another great week, right? S&P up about 1.5%, positive now for the year, getting back close, believe it or not, to the all-time highs that we were at a few short months ago before we had that correction in equity prices. Mid and small cap stocks fully participated and sort of in a textbook fashion. The higher the beta, the higher the up. So it was a broad rally in U.S. equities last week, very broad, with small cap up the most. Mid and small cap still negative for the year. International participated, and wow, up almost 20% on the year to date for the EFA. I still think that won't last. Why don't I think it will last? There's just not the growth there in these markets. There's not the underlying positive fundamentals. I think the international markets are really just moving off of interest rate differentials, the fact that the European and other markets are in an easing state, and that our Federal Reserve is doing, quite frankly, the right thing, waiting for better inflation data before cutting rates. So they're doing the right thing for long-term stability of our economy and strength of our markets. I'm proud of them. They're doing a great job in that regard. But that, I think, is the differential in the markets. I think the leadership in the international side is simply because the Europeans and the Brits have cut interest rates. All right, move on to economic data. Big numbers this week that were important. We've got manufacturing PMIs, both S&P and ISM. We've got non-manufacturing or services PMIs. And then most importantly of all, we've got labor market. And May labor market data is always one of the most important, if not the most important month of the year, because that's when the revisions come in, the big hiring surges usually take place. All right, let's get right into it. S&P Global May manufacturing PMI went above 50, 52. We're great. That was a great number. You can see that a little bit below the expectation of 52.3. Employment got above 50. All of that looked really good. And then we get the report that measures the same thing from our friends at ISM, Institute for Supply Management, and they say not so fast. Fell to 48.5. That was below the estimate. Imports dropping to a 16-year low contributed. New orders, though, did rise, and production did rise, and employment rose. Now, none of them were robust. None of them were above 50. So I would look at this and say, this negative number is probably more related to the big drop in imports. There was front running, different things happening. And I might rely a little more, this month only, on the S&P Global number. Maybe I'm trying to be glass half full here, but I think that's a reasonable assumption to make, at least until we get another couple of months under our belt. Then we move on to services PMI, and the S&P Global U.S. Services PMI rose from 52.3 to 53.7, well above expectation. That was great news indeed, because of course the services sector is a much, much bigger part of the U.S. economy, upwards of 85%. We got the sister report, I guess, from ISM, and in this case, also ISM fell below 50. So we're saying, what gives here? In this case, new orders fell, business activity fell, but employment rose. So, how do we interpret that? It's good to understand and take a look at. It's been years probably since I gave you some of these differences, but they do have different methodologies. The S&P Global reports tend to focus on big firms. In other words, the respondents to their surveys are big companies, large companies, while the ISM survey includes both large and small. There are some regional differences, some economic factors that could affect things differently. The timing of the services can affect things differently if it's right after a bad trade announcement or right after a good trade development. All of those things come to play. But I would say overall, looking at the 4 ISM reportings, slightly positive, nothing great, nothing particularly negative either. But if you want a negative print, here's where you look. You look at construction spending. That red line there, that's the year-over-year percentage change in construction spending, is rolling over. In April, down 0.4%. The estimate was for up 0.2. 3 straight monthly declines. Why? Inflation, just the inputs of production, tariffs affecting pricing, and uncertainty, tighter credit, right? It's harder to get construction loans, let alone mortgage loans for the end buyers if it's in the case of housing. There's curbs on federal spending. The administration is really trying to reduce the debt and deficit, or the deficit anyway, to the extent that they can. All of this is impacting the construction industries, and people are starting to feel it. Factory orders also took a little bit of a rollover there. You can see that a big month the prior month. That's a pattern we see a lot, right? Here's a good example. You have a big up month followed by a big down month. That has to do with transportation orders. So in April, factory orders fell 3.7, right after a gain of 3.4. Back out the big ticket items of transportation, i.e. airplanes, and it fell 0.5% for the second straight month. Wouldn't call it necessarily a bad report, but certainly not going to call that a good report. On to a good report. Job openings JOLTS report rose from 7.2 million open jobs to 7.4, 300,000 more than expected. Let's call that a positive. We can all feel good about the amount of job openings. Then we got the Ward's auto sales report, and it fell to an annualized pace of 15.65. That was below the estimate of 16 million, and that's the second consecutive month of a big drop. But remember, this spike here, these two that spiked, that all had to do with front running ahead of estimated tariffs. So if you were thinking about buying a foreign-made vehicle, you got out ahead of that and got that purchased a couple months ago. That would no doubt impact the sales once the tariffs were in place. So not a lot to read into that as well. Then trade balance, a huge drop in the trade deficit. You probably were looking at this chart thinking this was what we reported for the month of April. No, it's way up here. You can barely see it. Look at that. April trade deficit dropped from 138 down to 61.5 billion. That was even better than expected. Remember, a trade deficit, which we have, subtracts from GDP. If you close the trade deficit, you grow GDP. But then you don't have foreigners owning your dollars with which to finance your budget deficit. But that's another story altogether. But should we read much into this? Like this is a huge positive or big gain? Not really. What you had was front running again ahead of the tariffs. Let's build our inventories. Let's get things in before the tariffs go into effect. Then, okay, now the tariffs are in effect. We've got our inventory built up. So there's really nothing to see here. All right, so we got to wait. We got to wait till this data gets 3, 4, 5, 6 more months in the post-tariff implementation era before we know what the impact will be on GDP, what the impact will be on the revenue to the U.S. Treasury, and what it does with that incremental revenue if it manifests itself. All right, let's talk about the jobs market and labor because this is a big week. This was a big week for labor reporting. Not only did we get JOLTS, which I showed you earlier, then you've got the weekly jobless claims. We have been in this range, let's call it 220 to 230 of weekly jobless claims with an occasional spike. New York City kids go on spring break or Easter break and there's a spike. But this was a spike last week that was above the last 3. So a higher high in spikes. No real data to suggest anything. It's not an unheard of spike. You can see on the chart we've had others. But 247 is getting up there. Anything below 300, the labor market's still strong. So at 250, the labor market's still strong. But we're starting to see an upward trend. That's the way I would look at it. We've got a little bit of an upward trend. Continuing claims fell ever so slightly. Then we move into the BLS and the ADP report. We start with ADP, automatic data processing. They say private payrolls grew 37,000. The estimate was 114 after a 60,000 gain in April. That's not a great number. It's not a huge number. And May is critically important. But before I explain why May matters, let's go through the BLS report and then we'll kind of go back to that. Okay, the BLS report, that's the government jobs report. They say we added 139,000 jobs last month. Okay, fine. We added 139,000 jobs after a 147 in April, and people kind of got excited about that. But April's 147 was revised down from 177, so that's a negative 30,000 jobs. And May itself is always a big month. There are these seasonal adjustments. So what they do is May is a big surge in hiring as kids get out of college or as kids get out of school, and then they get hired for seasonal work, tourism, transportation, travel. A lot of construction takes place starting in the spring, and so May is a big hire through the spring and the summer and fall. A lot of the country has this thing called snow. And then the two reports are just different. So either way, they both do this adjustment. They sort of take off some of the hiring to account for that surge so that you can compare the month of May to the rest of the year. And they took that off as they always do, and instead of it being similar to the rest of the year, it actually went significantly lower. It wasn't negative job market creation, but what it showed me, bottom line, the job market is cooling. That helps with the inflationary data. That doesn't help with any data in particular other than the inflationary data. So we're going to keep an eye on it, see what happens. When you have a statistical revision month like May, a lot of noise gets in there. What happens for the rest of the summer is going to be important. I guarantee you the Fed, the FOMC members are watching that along with the inflation data. We're going to get some CPI and PPI this week. Speaking of that, here's this week's economic data. Not a ton. We don't have a lot of earnings going on because we're late in the final month of the quarter. We're into June, so we're about 4 weeks out from earnings again. We start with the financials, we move on. But for this week, we're going to get small business optimism. And then what matters this week, it's going to be weekly claims are going to matter. Do we go back above that 247 from last week or do we come back down? CPI and PPI are going to matter a lot. Beating on both of those, or one, would be huge because it would just reiterate what we've seen the last couple of prints, gives the Fed the ability to say, okay, now we can cut a quarter or a half a point, which is I know the administration wants, almost desperately wants to see. So watch those numbers this week. Watch any kind of progress or reversal on trade talks with partners like China. That could have a big impact on markets this week. But that's what I've got for you, folks. Keep listening. Thank you. Please give us a thumbs up, a like, a retweet. We really like to increase our listenership every chance we get. Audio only is available everywhere. Video on YouTube with the charts and the graphs. Thank you. I will be back to you again in a week. Take care.